think, last time I was here, I talked about four names and one went to zero and the other three, outperformed the S&P 500 by a wide margin. And that's pretty typical of what I do. Like, I'm going to be wrong, a third of the time. It's like John Templeton said, if you have an analyst who's right two-thirds of the time, it's a really good analyst.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
All right, we are back and going to do, as always, my favorite segments, interview segment. And this is a fellow I've had on before. And it was funny because he reached out via DMs on Twitter. And I sat there and I went, this is like the perfect timing because we've been banging on the door talking about a specifically international value. And that was precisely what he DM'd me about. So without further ado, Mr. Asheef Lalani is kind enough to join us today. Asheef, how are things, man?
I'm great. Thanks for having me back, Zach. I really appreciate it.
Yeah, you bet, man. I was thinking about the last time we did this. There have been some things that have happened since then and some crazy stuff. But one of the things I was interested about having you back on the show, and we're going to do some background and have some general market discussion before we get into the name that you want to talk about. But, there have been so many like-minded managers or investors that I've talked to over the last 15 years, or not 15. I started doing this about 10 years ago. And a lot of these interviews were really informative, at least for me, and really insightful. They also served as kind of like a group therapy session because, the paradigms have been so different in this cycle for so many different reasons. And we've covered so many of these reasons, and we've had Mike Green on the show and talk about passive. And I don't want to belabor the point, but the one thing that we have not really done is talk to an international investor, meaning, you and I both know, and it's true with any country, but I think in the world of finance, in the world of the U.S., or in terms of the U.S., it's probably more like that than anything, right? Because the U.S. is the financial center of the world, and everybody's looking at it, but by definition, when you're looking at it from the outside, and you see, you know what I mean? You're going to have a different perspective. And part of it's because you're driving around parts of the world. You're interacting with different businesses that are not in that market, right? You're going to see things differently. And as we all know, it has been a period of record outperformance for the U.S. versus virtually every other market. And one of our big theses is that is beginning to shift. And the value we see around the world is, and you've got a name that you want to talk about it, but the value we see around the world, especially on a relative basis, is unlike, and I said this, I've said it many times on the shows or in the show. I've been managing money for 18 years. I've never seen anything like this. I've never seen these types of valuations on rock solid businesses that appear to be inflecting higher. And yet no one's paying attention. And it's just kind of one of those things where you're looking around going, is this a trap? You know what I mean? Like, it's pretty shocking. But before we get into that, Asheef, why don't you remind us, kind of give us, first of all, a little, background on who you are, how you got in the business. And then I'd like to kind of get into general market structure discussions because I really want you to lay out, they've all heard what I've said. I want them to hear what a professional, insightful, fundamental investor that lives abroad thinks of our markets. But first, give us that kind of biography, if you will.
Sure. So my background is, I trained as a CA/CPA in Canada, worked at PricewaterhouseCoopers, was an auditor, and then switched to equity research in 2002. I went to UBS in Canada. And I did equity research for a couple of years. I did equity sales as kind of / risk arb salesperson / desk analyst for 6 months. And then I was asked to move into the prop trading desk. And our prop trading desk at UBS we called it the fundamental investment group. So we were like a Graham and Dodd, Buffett style long-term investing, value investing as our kind of our base, but we would have to be hedged, right? So it was trying to get leverage using the bank's capital. And I did that until 2012 when the Volcker rule came into effect, and banks were no longer allowed to do prop trading. And so since 2012, August of 2012, I've been on my own, just managing my own capital. I don't have a business. I don't sell anything. I don't sell a Substack. I really just share my ideas because I like the feedback that I get, and I like teaching. And I think those two together make it a worthwhile effort to try to share ideas. And since I last saw you, actually, I gave last time I was on, it was in April of 2021, and I shared 4 ideas. One did not work out. The other 3 worked out pretty well. And 2 of those companies, I ended up joining the boards of those companies. So I'm now on the
No
board
kidding.
of, yeah, I'm on the board of 2. They're related companies because they have the same common shareholder in Wexford Capital, which is a U.S. Hedge fund / private equity shop. And they're both gold related companies. So Mako Mining Corp, I joined the board in July of this past year. And Sailfish Royalty, I joined the board in 2023.
Okay, full disclosure here. I just want to know, I want everybody to know, I
Mhm.
did not know that you were invested in gold stocks. I did not know that you were on the board of gold stocks. So I did not plan this, people. I've been railing. I grew up in the mining industry, and I don't need to tell you any more than that, right? Like, I'm growing up in the mining industry and I'm pulling my hair out going, this is insane. But they've been hearing it from me constantly. So
Yeah, yeah.
continue on. This was not planned.
Yeah, I mean, to that effect, I will say, like, just generally, with mining stocks, I can't speak specifically about those stocks anymore because I'm on the board, and they ask you not to. But just generally, when you look at valuations for gold stocks, what you've kind of seen is that the gold price has gone up so much, and as a result, the margins for a lot of producers have gone up so much that there's actually been multiple contraction. And what's really fascinating, I was just talking about this with a friend of mine, Charlie Fisher, this morning. We were talking about how shocking it is that the GDXJ in the past year and a half is up almost. I think it's almost quadrupled, but the number of units are down by a third. And just shows you that you would think if you had made me bet if a stock was going to be up or an ETF was going to be up that much, that the interest in it would grow, not shrink. But we've seen the opposite. We've seen generalists, selling their positions because they've had a good run. And we've seen, I think what we've seen is the stocks have done well. And I think it's because the earnings are so high that a lot of quant-based funds that are value-oriented have been piling in. And so I think we've seen sort of a switch in the shareholder base from kind of generalists speculating on the gold and into sort of value type investors, including quants who are buyers. But there aren't that many of them around, value oriented investors. There aren't that many of them because I think one of the things that we've seen is that the number of opportunities are higher than they can handle, and than the amount of capital that there's available chasing it, because most of the capital, as you alluded to, has been going into the same stocks, into the ETFs, the indexes, into quality names, and that has really changed the dynamic in the market. And as a result, anyone who doesn't do that, who are active investors like we are, have way more opportunities than they have capital, and so the valuations stay lower than you think they should. But what it does mean is that absolute returns are higher than they have been in a long time. And I think you start to see that in the last 3-4 years, kind of since the pandemic. If you have a value-oriented strategy where you're looking at absolute returns, not buying a value factor ETF, that doesn't. You need to look at idiosyncratic stories and really understand what you're buying and what the returns are. The returns have been very good for those investors for the past few years.
And on a volatility basis, I mean, we do some hedging, but I was sitting there going through our performance from 2020, and I don't want to get into specifics because that brings in issues and stuff like that. But effectively, we're pulling about 80% of the upside of the market with a third of the downside. And one of the biggest reasons for that has just been those value names. They've started to work. The crazy part about it to me, and we're having a banner year, but our clients are kind of like wondering if this is kind of a crescendo. And I go, guys, when I look at this, I go, a lot of the stuff that we've owned that's gone up is cheaper now on a multiple basis than it was when we bought it. And I go, I don't think this is a crescendo, guys. I think this is an opening salvo. And one of the reasons I think that is because you and I both know there have been no flows. We were talking about this yesterday, and speaking of the gold and precious metals industry specifically, there have been no flows or whether it's investor flows or financing flows into that market since 11. It just got left for dead. Now stop and think about what has happened to the makeup of the average investor in the market over that time. Look what's happened to global market cap, US market cap, valuations, money supply, debt, deficits, all of that. Meanwhile, like you pointed out, there are less shares trading outstanding of those companies than there was in 11. When it starts to flow, and I think we're starting to see the opening trickles of that flow, it's going to be like trying to funnel 10,000 gallons an hour through a straw. You know what I'm saying? And that is extraordinarily exciting to me. And I don't know if you saw it, but there was recently, and it's actually a Canadian company that has got US, or maybe this particular one has Mexican assets. They did a financing on converts. Now they're not full production. I think they got a little bit of production going, but they're in the expansion mode, not startup. They just got 5-year convert notes that when you factor it all out, we're rolling at a negative cost of capital. And they're not even fully mature. And then you dug in it. Usually a financing terms like that, first of all, we've never seen financing terms like that in the mining industry. That's just nuts, right? But usually that'd be a sign of froth. It wasn't. What it was a sign of is you had 6 different parties that wanted to take the financing down, and they bid against each other. And that's what I'm saying. If so many of these managers want a 2% exposure to the metal and to the equities, this stuff's going to go ballistic.
Yeah, I think that what's interesting is, I've kind of resigned to not to expect multiple expansion, but just to be happy with, like, especially for those stocks that don't screen well, right? So anything that doesn't screen for quality, you can kind of assume you're not going to get a lot of flows. The multiple expansion you get is from when passive flows come in, you get multiple expansion. So as you have, if you're buying a smaller mining company, for example, and it's growing into a size that all of a sudden it's going to start adding to ETFs, you can really see, multiple expansion, something like that. But for the sectors as a whole, my kind of expectation is that you're just going to earn the return that the business earns, and the businesses are earning very, very high returns, right? So you should be very happy earning those returns. But I think return expectations are very high because stuff like Bitcoin and meme stocks and Tesla and all these things, they've set up return expectations to be incredibly high. And so if you're an active investor and you have to make a choice, people tend to chase performance and they want to get paid now because they think that that's you should be able to achieve those returns. They see everyone else achieving those returns and they want to also achieve them. But if you take a step back and go, hey, if I can, like I was telling you before, Zach, I use a 10% return hurdle for my work, and I managed to compound a little bit closer to 20 since I started, on my own 13 years ago. And it's because you get yourself into, if you're targeting 10, you get yourself into high risk reward situations, or sorry, I should say high margin of safety situations. You can end up, really outperforming, what your base level is effectively. And that doesn't mean you're right on every name. And I think, last time I was here, I talked about 4 names and one went to 0 and the other 3, outperformed the S&P 500 by a wide margin. And that's pretty typical of what I do. Like, I'm going to be wrong, a third of the time. It's like John Templeton said, if you have an analyst who's right 2/3 of the time, it's a really good analyst. And so I follow that along too. And the name we're going to talk about also, I think, follows that kind of mentality as well.
Yeah. Well, I always remind people, like, I think Buffett's historical miss rate is 38%. I want to say something like that, 38, 36. Anyway, right in there at that third. And those are excellent results. And on the value side, and people are like, well, yeah, but one went to 0. Well, yeah. So take 100 grand, have thrown 25 grand in each name, and then look at the total return.
Yeah,
right?
Well, sizing is so important, right? And I think what happens with a lot of institutions is because they have such a high fiduciary hurdle for the amount of work they have to do. they exclude stuff in the portfolio, anything that they can't put 5% in, they just don't even bother, right? And so when we're talking about, mining names, for example, these are businesses that have a lot of risk, right? There's a
Yeah.
lot of risk. Now you're paying a very low price, which compensates for the risk. But the way you mitigate that as an individual is to size small, right? So if you're making allocation to precious metals and you're picking a really tiny company, 1% position might be enough, right? If it goes up 5 to 10 times, it's going to make a meaningful difference still in your returns over a short period of time. And if you're diversified and you have a bunch of those, that's even better, because you
Yeah.
don't know
Well,
which ones are going to work and which ones aren't.
we haven't really talked about that, and I'm really glad you brought that up. I think it's one of the things that you overlook because you're too close to it for too long. Um, I don't know that I've ever carried a miner at a greater than 4% portfolio exposure for that same reason. The
Hmm.
other reason too is, right, the reason you want diversification is to try to mitigate idiosyncratic risk, right? You cannot mitigate idiosyncratic risk any other way in mining than diversification. There's no other way to do it because they are so idiosyncratic in nature, right? I'm reminded. I'll probably forget the name of it, but it was Summit Gold. Summit Gold. Remember the
Hmm.
Friedland disaster, right? Toxic Bob got him that nickname. He was actually a friend of my grandfather, knew him personally. But anyway, invested in some of his deals, and here's an example how crazy the idiosyncratic risk was. It, Beautiful project, all the numbers look great, but when they were going through it, and I'm familiar with this because my father had a really smart geologist that spotted this issue first and kept him out of the deal. But everything looked good. What they didn't factor in was the elevation of the mine. And the elevation of the mine required cyanide heap leaching.
Hmm.
There's an exponential curve on it that the higher you go, the more cyanide you have to use, and it becomes more and more expensive. And cyanide's incredibly well. When they went all through it, nobody really did the work. And when you factored in the amount of cyanide they had to put on, it made the returns. It took them basically down to it's just cost, right? No margin. And then, so they were using tons of cyanide, and then the bladder ruptured underneath and got into the river and all that kind of stuff. But perfect example, right? Altitude matters. And so
Right.
you have to you
Yeah.
got to spread your bets out.
Mining is all risk, right? Like,
Yep.
I think when you spend time with mining for a long period of time, you realize that, oh, there's so many ways to lose money, and so you have to diversify, for that reason, effectively.
And
Yeah,
that's
for
why,
sure.
and the other thing too is that's why management and experience matters. And if you look at some of the best natural resource investors, they follow around the same guys, right? Because they've got track records, they're smart, they're not hucksters. That's the other thing. I mean, now I will say the junior mining world now looks like it looks like the board of a God's assembly church compared to the crypto space.
Yeah.
I was laughing around. I was joking with some guys, and I was like, if you want to know what the mining penny market looked like in the '80s, just go look at the crypto world right now, right? Like
Yeah,
that's
yeah. I mean, mining lost a lot of its investors and promoters to crypto, for sure. I mean,
yeah,
especially in Canada, you could really see it, right? Like, you could just see people leaving, and you'd have companies that were changing their names from mining companies to crypto companies, right? So, like, it was pretty obvious. It's all mining, right? So that's what they'll say, right? And so you find this that there's a lot of, because with crypto, the interesting thing about crypto is that, or Bitcoin in particular, let's say, is that it's entirely what I call social value. There's no intrinsic value associated with it, right? And so, when I sort of had to develop a new thought process for how I invest, in terms of looking at stocks, where I came up with a model where it's market value equals intrinsic value plus social value. And so I'm trying to buy stocks that have negative social value, meaning that they don't fit in what everyone likes or wants to own, right? And so, when you think about things that can cause negative social value, well, it can be stuff that is very simple, like, not in a large ETF, not in a benchmark, not has a high debt, has volatile earning streams, unpredictable earning streams, and you can go down the list. And obviously, stuff like mining and oil and gas, even banks to a certain extent, can fit into these categories. Because the earnings aren't steady and growing, right? There's real, there's volatility because either they're price takers or they're related to interest rates or whatever it may be. So if you can find stuff that are good businesses run by high quality people with skin in the game, that are trading cheap for bad reasons, that to me is where the sweet spot is for long-term investors who want to generate absolute returns.
Now, to get to the reason, well, other than I think you're a smart guy and I like chatting with you, but to get to the reason, one of the reasons I want to have you on is something that I've learned is that when you see big opportunities like this, and we're just talking about the markets generally, you and I are both, talking about the opportunities we see in value, basically anywhere outside the S&P 500 and the NASDAQ, right? Doesn't mean it's all good, but if you go digging in those places, you're going to find gold. Pardon the pun. But one of the other things I've learned too is that when you see environments like this, don't just spread your bets on names. Look for people. Look for people so I see this, what I believe is a generational and a lifetime value opportunity. I think that there are dollars selling for 10 cents all over the place. And when I start, so then I think to myself, okay, I want to take maximum advantage of this, right? And a lot of those value plays happen to be outside the US for reasons that we've already discussed. When I start thinking about value plays outside of the US, there's a name that usually pops up in my brain, and it's Prem Watsa. And getting to the point of what I learned is when you see an opportunity, I tell my guys this all the time, guys, we don't have to come up with the idea. We just need to find the guy that did, right? Investing is a name of, it's the ultimate, no one cares how you got it in your portfolio, just get in your portfolio, right? And I've been thinking about him and thinking about the look through that he's got to international markets, just his background, his attention to value, often called the Canadian Warren Buffett. And I had been thinking Fairfax, which is the name of his company, had popped into my head several times. He's a guy I've kept in the periphery. You sent that DM and I went, okay, we've got to. Yeah, and I don't know if you've come to that, but one of the things that cues me off to names or that I might be on the right path is when the same idea keeps coming across my plate, right? And and from places that I trust and think a lot of, and if I see it 3 or 4 times, I go, hold on a second, I need to stop and take a look here. So why don't you discuss what you believe is attractive about Fairfax and just take us from the start to the beginning of what you're looking at?
Sure. So I like Fairfax a lot. In full disclosure, I made it 58% of my net assets, which I've never done before. I've never concentrated like that before. And we talked about diversification, and here I am with a really big position in one name. But the company itself is very diversified, right? We talked about it being like that Prem is the Canadian Warren Buffett. I think he's the Canadian Prem Watsa. I think he has done something. He's taken from, borrowed from, let's say, from Buffett and from a lot of the other sort of value investor legends, or investing legends like a Phil Fisher, a John Templeton, Henry Singleton. He's taken a lot of these ideas and I think made a better mousetrap with Fairfax versus Berkshire Hathaway. And I know that's a big claim to make, but I think it's backed up by the structure that they've set up and the culture that they've generated. And I became a shareholder in early 2021, and I didn't really appreciate what I owned. I don't think I shouldn't say that. Every year I became more and more confident of what he had built, and I understood it better and better. I think. To the point where I kept adding to my position, every year since I put it on, which is how it's become so big. And when you think about what Berkshire Hathaway's business model is and what Fairfax's business model is, it's the same business model in the sense that they're both property and casualty insurance companies that use the insurance float for leverage. So that they can have a much bigger investment portfolio versus the shareholders' equity, right? And I think the sort of innovations, call it, but really just being a little bit more aggressive. I think that Fairfax has done is that they also borrow some money at the holding company, and they term out their debt really long term at the holding company. So they're taking a little bit more risk for that reason, but it's very intelligently set up risk, such that, you know, these are approximate numbers, but there's about a $75 billion investment portfolio and about 25 billion of shareholders' equity. So you have a 3-to-1 leverage on your shareholders' equity, which means in the current the current interest rate environment, they're earning about 5% of coupons on their fixed income portfolio, which is 2/3 of the whole portfolio, right? So effectively, you have 50 billion of fixed income investments earning 5% versus a $25 billion equity portfolio. So your already starting point just on that is a 10% pre-tax ROE. Then you add in another 25 billion of equities, and expectations for the equity portfolio by analysts are pretty low. Like they expect sort of a 5% type return from the equity portfolio. Well, Fairfax is targeting 15. And if you look at some of the stuff that they own, they're earning higher than that based on their carrying value, right? So Fairfax owns 32% of Eurobank, which is one of the largest banks in Greece. And that business has a mid to high teens ROE on tangible book value. And so on their cost basis, that alone is contributing $25 a share of earnings to Fairfax. And they own a shipping company called Poseidon, which David Sokol is the executive chairman of. And David Sokol, for Berkshire Hathaway followers, is a familiar name. He was supposed to be the heir apparent to Warren Buffett before he left. And so he started this Poseidon, and if you look at their valuation, they have it trading around, on their carrying value around 7 to 8 times. So that's earning a return over 10% as well. And because these investments are greater than 20%, they're equity accounted for, so they're going right into earnings, their share of the earnings effectively. And so it's pretty easy to get to the 5% return from just their top 3 investments. And then everything else, if it contributes more than that, you're already at like a 15-20% plus pre-tax ROE just from the investments. And then they also have an underwriting business, and the float makes money as well, right? So you think about it from a simplistic perspective, which I think most investors, I think they really focus looking backwards, and they don't look at what you actually have. And so they get sort of wrapped up in the historical returns, and they get wrapped up in the historical multiples. And so their inclination is to start to sell when the multiple gets closer to 1.5 times book value, because that's kind of been a high end of the range for the past 15 years. But you have to remember that 10 years of that, we had interest rates pretty close to zero. So you weren't getting that ROE boost. You weren't getting the leverage from the float. And so this float was kind of just sitting there earning almost nothing. And then when interest rates normalize, all of a sudden the ROE boost is gigantic. I estimate it's been like an 8% boost in their ROE, which is easy to calculate, right? You go from 1%, returns to 5% coupons, 4% times 2, it's an 8% boost in your ROE effectively by just having interest rates normalize. And so when you look at the business and you look at what's on the investment portfolio that's undervalued, that's going to probably get realized over the next 5 years, and you look at the positioning, it's just really, really hard not to get a 15% ROE on average for the next 5 years. And if you have a 15% ROE, then you double, right, after 5 years. And that's the low end, right? So my sort of estimate is it's like a 90% confidence interval that they'll do better than a 15% ROE. Well, my hurdle rate's 10. So I feel like the chance of it going down to 10, it might be a 95% chance that they do better than 10. And there's always, risks that you can't account for, so you have to leave a possibility that you're going to be wrong. But my perspective is that it's going to be really hard to be wrong. And it's supported by the company, buying back stock pretty aggressively. Last month, they bought back over 1% of the shares outstanding.
What took? I'm a little bit surprised when I pull up the chart. That thing's been on a runner. What inflected right around? I mean, obviously we all know what happened in December 2020, January of 2020, and COVID and all that kind of stuff. But
right.
I got to believe there. I'm looking at this chart, and I've got to believe there's more to it than just a bounce after COVID. What inflected 5 years ago?
I mean, it was interest rates for the most part,
Okay.
right? So you had a couple of things, right? One, you had a really hard insurance market start, and
They
then
didn't. They
interest.
didn't. They didn't. They didn't get caught holding a bunch of duration.
See, they're value investors in every part of their business, right?
Okay,
So
so they were
and
aware of
which
the
means
bond issues.
they use common sense, and so and a lot of when I speak to investors, I speak to a lot of investors, institutional and retail, and when they look at the company, they really want them to match their duration of their bond portfolio with the duration of their claims, right? So when you have an insurance business, you're writing all this insurance, you're collecting premiums, you go and you buy bonds with it. You have to buy bonds with the premiums, and then you try to what most insurance companies do is they try to match the duration of their liabilities with the duration of their fixed income portfolio, right? Which is a logical thing to do if you don't want any matching risk. But when rates are 1%, why am I going to take all that duration risk? And which is what they decide to do. So for a long time, they were earning 1% where their peers maybe were earning 1.5%, and their peers were all buying corporates as well when spreads are really tight, like now. And Fairfax has kept most of their portfolio in treasuries. And so they basically are using common sense and saying, well, I'd rather stay short duration. And this was a brilliant move because you caught it directly. So what happened is because they were short duration, when interest rates started to go up, their peers all had giant holes in their balance sheets, right? And so that caused the hard market to get even harder. And so that allowed Fairfax to grow premiums 20% plus for a few years. And so they grew the insurance business so much that they're now a top 20 global insurance company.
Wow.
When you think about all their insurance subsidiaries. And so they took advantage of that big boost, and that really increased their float dramatically. And what they also did is buy every share they could buy, and they got creative buying shares. Like they sold. They have a financing mechanism that they do where they'll sell a minority interest in one of their insurance subsidiaries, and they sell. Even though it's the shares they sell are considered common, they have effectively a preferred rate of return. So they're basically locking in financing at like 6% a year, up to as high as 8%, depending on what the reference rate is at the time that they enter into these preferred share agreements. And they took that capital and did what's called in Canada called a substantial issuer bid, which is a Dutch tender effectively. And they bought back, I think it was 2 million shares at $500 a share US. Now the stock is about 1770 or so. They made 3-to-1 on that investment. They entered into total return swaps on their own stock for almost 10% of the shares outstanding. They still have 1.77 million of those total return swaps outstanding. So they make money when the share price goes up as well. And then again, when you think about why they did that, it's because they wanted all their capital to grow into premium growth, and so they had to get creative as to how they use leverage to buy back shares. And they have exposure to a giant amount of their shares that eventually will be bought back. But for now, they get cheap financing, borrowing at floating, probably like a small premium to the Bank of Canada rate or the U.S. Fed. So they're very creative in how they do it, and they've also gone out and used the normal course issuer bid or the regular buyback, and have been buying stock back pretty aggressively as well. But as soon as the premium growth got really strong, and then as you go forward 3 years, the insurance companies that were all had their duration longer and had taken this big hit to their balance sheet. Well, 3 years later, all those bonds are back up to par, and they're making more money on their bond portfolios, and so they're able to go out and write more business. And so you'll notice that a lot of these other companies are trying to grow their premiums a lot more aggressively, and Fairfax has kind of taken their foot off the accelerator in terms of premium growth, which means that they have a lot more excess capital to use for other things, and they've been using it to buy back stock, to retire some of the TRS. They retired 200,000 out of the 1.9 million TRS they had at the beginning, and they're going to buy in this minority interest that they had sold as well eventually, right? So it's just a brilliant approach to investing where you're kind of just using common sense, which is really what value investing is. It's common sense, for all intents and purposes.
Would I be right to assume that when spreads blow out, which they will eventually, that Prem and the boys are going to be licking their chops? Because I've got to believe that, you know, that guy knows how to break down a business and look under rocks and see. So he's going to be able to filter through those and pick some diamonds out of there. I wouldn't be surprised at all if he picks up grade A assets throwing off 8-9% yields when things pop. Am I right looking at that and thinking all the factors that we're talking about will get turbocharged in the event? Well, when?
Exactly.
When?
Exactly. I think that's why it's such an interesting place to put capital if one's worried about financial markets in general, about overvaluations in the market. You know, they've made it very clear, like there are two priorities with their excess capital, because, like, you know, they have probably 6 billion or so out of the 75 billion that they could move into equities if they want to. Also, out of that $50 billion bond portfolio, like you said, they can buy corporate bonds if spreads widen out. And they're preparing for that. You know, they even their equity analysts are kind of focused on, well, which credits are we going to buy when spreads widen. So they're
getting the game plan ready.
Yeah, they've been ready for 2 years, and this just hasn't happened. So,
Yeah.
they did during COVID, and during COVID they bought a bunch of corporates because spreads widened out temporarily, and then those matured, and they tried to keep it. I think they only went as low as single A, so they weren't taking a lot of risk when they were doing it. They've been more creative trying to get diversification. So they partnered with Kennedy Wilson, who they're trying to buy out the minority of right now. And Kennedy Wilson is a U.S. listed real estate company that has partners that invest in development properties, and also they do loans, development loans. So during the banking crisis from a couple of years ago, the tiny banking crisis from a couple of years ago, when Silicon Valley Bank went down, they bought PacWest's business, and they do sort of high loan to value loans on development properties, right? And because they know how to develop stuff, they don't mind if they prefer to get paid, obviously, but if they don't, they think they have really high margin of safety on these loans, and so they're able to earn like 7-8% on those types of things. So they've supplemented the portfolio with some really creative high margin of safety lending to help boost their returns while they wait for credit spreads to widen out. But they could, if they were like the other insurance companies, they could allocate significantly more to corporates if the spreads ever widen, and to equities. And they've made it clear that they want to buy quality equities when the market falls apart. When, I don't know, it's going to happen. I imagine at some point we're going to have an issue that makes it happen. It's hard to see it with the current market structure, but these things tend to happen from time to time. And when you think about that, when that does happen, it just supercharges your returns because you're getting 3-to-1 leverage on everything that you do. So you can really see how your ROE can go from the high teens to the high 20s, maybe even during that kind of situation, and no one's expecting that. So you really have exposure to these like giant right tails, while the left side is pretty protected because as long as the stock trades at current valuations, they're buying back stock anyways, and they're very happy to do so. For a lot of their competitors who have high teens ROEs will trade north of 2 times book value, and Fairfax is trading around 1.5 times book value. And so that is, I think there's an opportunity here for not just the growth in the book value, but also for multiple expansion. And one of the triggers to get multiple expansion is being added to a benchmark, as we were talking about before, as we've seen with Carvana, right? You get big multiple expansion when you're added to an ETF. Now, the Canadian ETFs are the amount of money benchmarked to Canadian benchmarks is obviously significantly smaller than for US. And so Fairfax, it was just announced last Friday that it's going into the S&P TSX 60, which is our version of the S&P 500, and it's a committee-based approach, and it makes up part of the Global 1200, the S&P Global 1200. So Fairfax was just announced to be added to that. It'll be effective as of next Friday's close. But that's buying of approximately 3% of the float that will have to be bought. But also, everyone who's benchmarked to that index has to start considering whether or not they want to make Fairfax part of their core portfolio, as opposed to something that they are okay being underweight. And despite the historical performance that we've seen over the past 4 years, they're all very reluctant to do so because of past experience. Because the stock had a period where it went sideways for 10 years, they're not interested in buying because they don't really understand why it went sideways or why it's gone up recently.
It went sideways because 40% of their book wasn't in Apple.
Yeah. I mean, that's a big part of it. I mean, they were short the market back in in the early aughts up until like 2016, right? So they were short because they thought that they were worried about negative interest rates, right? So and people give them a really hard time, and it was absolutely the wrong move, and they concede that, and they've said they're not going to short anymore. But the reason why they did it is because there was a real concern about negative interest rates at the time. At least this is how I interpret why they did it. There was a real concern about negative interest rates at the time, and if you're an insurance company, you have to own bonds. That's a really scary place to be, right? So they put on deflation hedges to try to protect against that happening. If that was an explanation for why rates would go negative, and they shorted the market because they assumed that if that was going to happen, the market would also go down a lot. And unfortunately, they were short the market in long value stocks, and we saw a big rotation out of value. We saw it for probably 15 years from the great financial crisis because investors who lost money during the GFC wanted to avoid losing money again the same way. And so they set up a bunch of rules and heuristics, which basically herded everyone into the same stocks, which are these quality stocks that have consistent growth, which is why you see, companies like Costco trade at 50 times earnings. It's because their earnings predictability is so high. There's never a reason to sell. And so,
Well, except when it gets to 50 times earnings.
Well, it might be a reason for you and me.
Yeah, right.
Because we have alternatives, but in reality, for a lot of people, they're like, well, if you think about, well, if it's going to go from 50 times earnings to 30 times earnings over 30 years, I did this math before and I haven't done it again, but it works out that you can still make a 6 to 7% return, over that time if you're growing at 10% and you have, but
only issue is multiple
they're all
contraction
alternatives.
doesn't usually happen steadily over a 20-year period of time.
Exactly. There's going to be surprises. There's going to be big drawdowns. And look, every time one of these quality stocks has a big drawdown, the buy the dip mentality kicks in. And I do think that's one of the, when I talk to investors, I said there's several ways to take advantage of this market structure. One of them is to buy quality when it has a blip, right? So when there's a stock and you can appreciate. And Meta to me is the best example from 2022, where they said entirely under the control. They said we're going to spend a bunch of money on the metaverse. Earnings estimates get hit. Every quant knows that when earnings estimates go down, you have to sell the stock because stocks always follow. And anyone who's been competing with quants also knows that. And so they look for those cues,
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate and actual performance may differ.
I have never, and when I talk about this, it is not in the way that guys on Twitter talk about it. Like, I am so smart. I did some really good things with Meta. I didn't play it perfectly though, but this was a shocking realization to me, and it pulls me into a larger conversation that I want to ask you about. But markets, you and I grew up watching markets discount everything, and we were fairly large shareholders in Meta at that time. Enjoyed a really nice run throughout 2021, and we sold it at the end of 2021, right around its high at that point. And the reason we sold it was because Zuckerberg was talking about the 20 billion spend on the metaverse. And I kept looking back and going, why has this not made the stock blink? And a buddy of mine that actually worked at a hedge fund was the one that brought it up to me. And he goes, it's freaking us out. It hasn't even calculated about it. He said he's spending the money. There's no reason to doubt him. We cashed out of Meta, and I went, you know what, man, I'm going to do the same thing. They come out Q1, announce what they told everybody that they were going to do over the previous 2 quarters, stock plummets.
Right.
And now I was thrilled that we got out of the way, But I was sitting there going, why? What in the world? Like, this is the dumbest reaction I've ever seen. Do you think that, are you positing, and if you're not, tell me what you're thinking, but do you think that was primarily caused from just guys looking at the numbers and they weren't going to recognize it until the data hit the screen? And so that's kind of broken the market, hasn't it?
Well, I mean, I think ultimately, the way money is run now is, well, there's two parts, right? One, you have the passive demand that's constant, right, and it keeps coming in, so it really helps, and the passive demand, spreads out. Like ESG was a big thing back then too, and it's still probably pretty big, but all the money kind of gets herded into the same stocks. So ETFs, might own 25-30% of a stock in the US, right? In the S&P 500, right? Like a really big, like an Apple or a Meta, where it fits into every ETF, right? You can find a way to get into everything. And so what happens is it's the quants that have to send a signal for people to get out. And the signal is when the earnings estimates get cut. I think analysts have more power now than they ever did. I think when
Clearly.
right?
And now,
And
I think they're dumber than they've ever been. But no, just because you and I, again, we've talked about this on the show. Even when an analyst report would come out on something that you were long and it was like, you just never really saw analyst reports move anything because we all know the game they're playing and it's ridiculous. And I kind of think it's the retail domination that's come into the market. All of a sudden, analysts put out these reports that are, most of them are just vapid garbage. And boom, the stock responds like it's God's gospel truth. It makes sense.
I think it's a signal. I think it's the signal that the earnings estimates give. Yeah, I think that's definitely the what's driving the moves. And it's also like how predictable the earnings are as well. So if the analysts are all crowded around the same number, for a quant, that's like, oh, historically, if the predictability is high of the earnings, then the stock performance is also high, right? Because everything's a correlation, right? So they're looking for these, they're looking for whatever factors are working. And so when they and unsurprisingly, if you have earnings estimates that are always going up and to the right, you buy. And if earnings estimates slow, you sell, and Fairfax had a very similar situation. I think this past summer, one of the reasons why the stock was going sideways, it's kind of gone sideways since June. A couple of reasons. One, I think the during hurricane season, the stock tends to underperform because people don't want to own the stock when there's hurricane risk, right? They just want to. I think if it's not in your core portfolio, that means you're stepping out of your core. If you lose money because there was a hurricane, your client's going to call you and go, "What the hell are you doing, being exposed to this risk?" Right? And so they tend to avoid the stock. So you usually see underperformance for Fairfax from kind of June 30th to November 1st.
It'd be like loading up on a nat gas name in April.
Right. Yeah, exactly. Like you don't know how low the low is going to be in terms of the gas price, and here you don't know how bad the storms are going to be. This year we didn't have any major storms, and yet the stock underperformed worse versus the Canadian financial ETF than it ever has. And the reason was where people were switching into banks because they wanted the cyclical exposure, because the economy was doing better than people thought it was going to do after tariffs, and they wanted to get out of insurance names because rates were coming down, and they knew interest rates were a big driver of income, and the insurance market seemed to be softening, right? And Fairfax in particular was slowing its premium growth more than anyone else, because the insurance business is just another asset allocation exercise, right? Like it's investing, right? You're making a probabilistic bet every time you write an insurance policy, and you're going to lose on a big chunk of them, but the ones that you win on make up for the losses. It's the same thesis as any probabilistic investor, like me and you would have, right? We making the decision based on, well, what are the expected returns when I write this policy? And when insurance markets start to soften, that means premium growth starts. You're not making as much of a margin as you would when it's a hard market, and so you have an asset allocation decision to make. Well, if I slow my premium growth because I'm not earning as much as I used to, because all this competition's come back, because all these insurance companies have their balance sheets fixed, I'm going to avoid competing with them, and I'm going to go buy back my stock instead. And so that's exactly what Fairfax has been doing. But what's interesting is that the signal to a market who's focused on quant investing through a quant filter says slower sales growth, they say sell, right? Like they just sell because they see slower sales growth, because for every other type of business, that's exactly what you're supposed to do. But insurance is not every type of business. And you can tell how much trouble quants have with insurance companies, especially insurance companies that look like Berkshire, Markel, and Fairfax, which all have the same business model. They don't understand it. You look at Morningstar's research; they hate these stocks. They have no interest in them. For Fairfax, they have a target of that's I think like
Well,
two
to be
thirds
fair,
of the current price.
well, can you explain? To be fair, and correct me if I'm wrong, but it's I've never really thought about it that way, but it's probably because they're looking at the underlying business. And when you look at a Fairfax or a Berkshire, the equity portfolios and the investments that they make with the free cash flow coming off the business are going to drive the returns more so than the underlying businesses anyway.
Yeah, that's a big part of it, but also the float looks like debt, right?
Right.
So you have,
Yep.
if you go back and you go on YouTube and you look up like Warren Buffett float, right, insurance float, and he'll explain to you what he thinks insurance float is worth, and he thinks it's worth more than book value, right? Because when you think about what insurance float is, as long as you have a high quality insurance business, which Fairfax has and Berkshire has, where your premiums are always growing or flat to growing, effectively your float is constantly growing. So you have a liability that's always growing. So effectively you never have to pay back, but you get use of all the capital, right? So if someone told you, hey, here's $1 million, you don't have to pay me back, and you get to keep all the interest. Well, that's an asset to me. It's not a liability, right? But for a quant, it's a liability, and so it makes the company look more levered than it really is. Because unlike a bank, you can't have a run on an insurance company, right? Unless you're entirely invested in one type of insurance, which is what happened to the mortgage insurance companies during the GFC. But for highly diversified, you can't have that.
Right. So again, trying to distill this to make sure that everybody really understands. There's so many different ways I want to jump at this right now, but if all things, like if you're looking at 2010, okay, and you're sitting there, and you can even stretch it out 2013, and you're looking at 8 and 9 PE ratios on companies that are bumping along at 2-3% growth, and you're looking at 18, 19 PE ratios on companies like Apple that are just cash flowing like crazy. This is a completely logical way to program a quant, right? But you reach a point when value is not part of the consideration, and that's not what the quant's geared to look at. You reach a point that naturally becomes the inverse of your starting point, right?
Right.
Because the value discrepancy gets so large that while the things the quant is looking at, that's fine, but we're not looking at underlying value, right? And so you look, so I want you to talk a little bit about that, but also I wanted to focus on something that you said, because it's something I've been thinking about, and I am not at all putting myself in the category of Prem Watts or Warren Buffett. Okay. So I want to put that out there, because we were talking about how he was short the market and the reasons he was short the market. I've got a working theory on this and I wanted to run it by you because I've seen it play out in my own career. Because of past experiences and what was considered responsible management and risk management, I brutally underperformed between 2010. Well, we crushed the metals trade. So from like 2012 to 2016. And in hindsight, what I realized is it took me 4 years to adapt my mind to the new environment, because risk really had been transformed at that point. It wasn't the financial repression. We didn't realize the raw power that central banks had to pin rates. You kept thinking that they would lose it here or there, right? But when there was zero restriction on the creation of capital, looking back, you go, actually, there's no way for them to, when it comes to deflationary pressures and supporting price, there really is nothing they cannot do. If you can just push a button and create cash, and we kept thinking about it with the natural limits that have always applied to investing. those rules got spun on their head. And my working theory in that is that now in a much smarter, much more erudite way, Prem Watsa and those guys had, go look at Buffett's performance until he picked up Apple. It was the same way, horribly lagging, right? I think that all of us guys that look through the market through that traditional lens, it took us that long to figure out how the game had changed. Well, what are your thoughts on that?
I think that's true, and I think what sort of happened is that you had sort of this change in the market where all this money again went to quality. Anything that didn't screen well, valuation went way down, and it took such a long time for that to happen because I think David Einhorn's talked about this a decent amount where he says that value investing is dead or the market's broken, and what he's talking about is before the GFC. There were so many active investors who were trying to take advantage of small mispricings, the key was the speed, right? And so they would try to get ahead of, this stock is trading at 10 times earnings, it should be 15 times. This other one in the sector is trading at 20, it should also be at 15 times. I'll go long one, I'll go short the other. Every other investor who invests like I do, who's not as fast as me, who's at, let's say, Fidelity or some big shop, is going to see the same thing I see, and then they're going to start selling, and they're so big, and I'm so nimble that I'm going to take advantage of these mispricings. And it worked really well. That's exactly what we did at UBS when I was on the prop desk, right? We would have long short books. Every sector would be long and short, against within the sector, and we'd have a bunch of names on, and we would just take advantage of these mispricings over time. It'd be right sometimes we wouldn't, but enough that we made money. And then after the GFC, I started to notice it was getting much harder. I'm probably lucky that they shut us down in 2012 because of the Volcker rule. Because I think it was becoming harder.
The opportunities were still there. When you say it gets much harder, and I don't mean to interrupt you, but when you say it gets much harder, I'm assuming I know what you mean, but I want to know I know what you mean. There were tons of opportunities. They just didn't respond like they used to.
Yeah, exactly. And so if you were still trying to follow that same path, you ended up blowing up, right? Especially if you're in a long short type situation, right? Mm-hmm. And all the money transitioned into these. They're always in pod shops, but the pod shops changed, right? And they understood faster, I think, than I did for sure. What was happening and how quants were driving everything, and so they started to look at more at factors directly as opposed to just having a fundamental view on a stock, and so I think that was the sort of the transition that happened, and I think it persisted for so long that so many of the managers who managed money like I did all got taken out and shot, and they don't have their businesses anymore. And the guys who have the best performance are the ones who recognize this or just bought quality and never sold, right? Like, up here, you'll have lots of investors who bought, a lot of the Mag 7 names and bought, Visa and MasterCard in their financials book, and they would sell other stuff. And it worked beautifully to outperform the market for so long. Because some of these companies are really special, right? Like they are really special. They are really great businesses, and they've grown dramatically. The question is, at what point do the multiples get so big that you're like, I can't chase those, and I can't play that game anymore. But the guys who have the best performance are the ones who never sold those names, and they're not changing their strategies, So no. and they're getting the capital whenever time the market sells off. They're the ones who get the capital, right? So it's hard to see how this paradigm shifts. I think you probably see that the quants are the first ones to leave, but most managers are just following quants and didn't realize that that's what they were doing. So they're stuck in the same names, and will take the drawdowns when they happen.
I think that and we'll see where I'm right. I'll probably, very, very high probability that I'll regret saying this, but I think it started to happen. I think it's going to be much less dramatic than people are expecting. One of the things we've been telling our clients is, look, for all of these factors, the way the game has changed, participants, when you're looking at valuations in the U.S., you cannot dismiss the potential of a nasty, violent market deal, right? But when I look at, a government that's running deficits at 6.5%, 7% of GDP, I look at all these different factors going on. It's hard for me to envision a scenario like that. But one thing I think people are missing is go look at U.S. relative performance to the rest of the world this year and compare it to the last 15. something clearly changed. And like you and I know, a lot of those quants, a lot of the investors, they're going to chase what's hot. Now, they have not abandoned U.S. markets at this point, but that's kind of one of the things we're saying. I have a joke, which is at the top of bull markets, everybody's a technical analyst, and at the bottom of bear markets, everybody flips to being a value investor, right? So now all of a sudden they want to know what they own, right? I think that paradigm is starting to flip a little bit, and I think it's the reaction of some of the names. It's some of these names, as silly as it sounds, it's watching a stock pop 15%. It's deeply undervalued on earnings, and you see them with a revenue pop, and you're like, that makes sense. Where before you might get it in after hours and it fizzles off for all the things that you and I, all the reasons we've discussed. But it does feel to me like that tide is turning a little bit. And I also think that one of the things I had to really discipline myself with over the last couple of years was quit looking at the inefficiencies of the market and being frustrated. Start looking for the opportunities. And I'm probably early on that. I usually am. But it just got to a point for me and us where you're looking at the world, and you and I were talking about this off camera, but you're looking at the world and saying, look, I don't know exactly what's going to happen. That humility always needs to be ever present. At the same time, if I don't buy that, and I'm wrong, that's going to be very hard to explain to my clients, right? Because my fiduciary responsibility, this delta's gotten so wide, I can't explain it away. And so I said to him, I go, fellas, whether we're right or wrong, we don't have a choice here. We have to look elsewhere. Do you where do you think we're at in that cycle?
It's so hard for me to say. Like, I think as long as an investor focuses on absolute returns, I think it's the most inefficient market I've seen in my career. And that was from 2002, right? So I look at it and say, look, if I can earn a 15% return, with a high margin of safety, which is what I think about with Fairfax, I need to own it. And I'm okay if I only earn 15, the market goes up 20% a year. That's something I'm okay with, because ultimately my goal is to try to grow my assets. I just don't think the market can go up like that forever. And it's probably happened longer than most value investors ever thought it could. And so it becomes very frustrating, and clients, they want to chase the returns, and they have an easy choice of just selling everything that's actively managed and buying ETFs and just getting passive exposure, right? I was just listening to Bill Brewster's podcast, The Business Brew, and he's talking to a gentleman who started up a new company where they borrow a lot of money from non-recourse capital, and they buy the market for you, right? So they try to give you like 5 times the leverage, so you can buy the market without recourse. So you don't have to worry about being shaken out of your position.
Hold on, wait. What do they do? Run that by me again.
Yeah, so they effectively they lend you money at SOFR plus 2%, which is around 6% right now. And you buy the market, S&P 500, some mix of ETFs, and some private credit funds, which might own public credit as well as private credit and asset-backed securities, and so a bunch of stuff that earns a return with a double B credit that's SOFR plus like 500 basis points, right? So you have enough income from the bond portfolio to pay the leverage off that you're borrowing, but you're getting much more exposure to the market than the amount of capital that you have, right? And it's a very elegant solution to get people leverage so that they can buy the market, but everyone owns the market, so you become a bit concerned that if you have a long period of time where the market doesn't go up, that you're not going to get a very good return, and that scares me. And then I compare that to Fairfax, where I go, well, I'm getting 3-to-1 leverage from their investment portfolio to the shareholders' equity, and I'm getting paid to take a portion of that leverage because I'm making money on the underwriting, right? So that to me seems like a much safer setup than doing this other strategy, So
So what
And so,
happens? What happens to that strategy when yields go up and the S&P drops 30%?
well, the bond portfolio will be that they have will be making more money, so they'll be able to
So
offset the leverage risk.
so
It's
they're
the
keeping it short term, I would think.
Yeah, I'm not sure about what the duration is, but effectively, because they've locked in non-recourse and long duration debt, they believe they can ride out every cycle. Because what tends to happen when there's a big market collapse is that there's a lot of money printing. Credit lines get opened, money flies in, markets recover, and so they're kind of betting on the same outcome that we've had for the past few cycles. And it might happen. I'm not going to say it's a bad idea. It's just
I,
that if that idea is interesting, then Fairfax is way more interesting.
I
So
agree, but don't. Okay, and look, full confession. Looking at things like this has made me miss some big opportunities. Okay, but when I hear leverage without risk, now and I know he's not saying that, but when I hear
yeah,
leverage without risk, I just go, "Oh, I've heard that too
yeah,
many times. It
yeah.
never works that way." And every time somebody thinks they've created, I'm reminded of the Dr. Seuss book, right? The Star-Bellied Sneetch Machine. I don't know if you ever heard that. But when anytime somebody makes a magic credit machine that can give you the benefit of leverage without the downside, I've just never seen it shake out that way.
Yeah, yeah. Well, the one business where it worked for Berkshire and for Fairfax is getting the leverage through the insurance business.
What?
That seems to be a safer way. Obviously, there can be large
Well,
losses in any given
well, here's
year.
why. Well,
You
here's
know,
why. When you go through a recession, 25% of your customers don't stop paying their premiums.
right,
Right? Like, I mean, that's a
right.
big difference. Whereas when you've got businesses going bankrupt, they're going to stop paying their right. They're going to stop paying the VIG. So
Yeah,
yes, I totally, and it's
yeah.
one of the reasons I've always been frustrated that people don't understand the insurance business because it's the best cash flowing. If you're worried about people not paying their car insurance, you've got bigger things to worry
hmm
about. You
hmm
know what I
Yeah,
mean?
and,
So,
and car insurance is much more complicated. Not complicated, but it's a different kind of business because you're dealing with a lot of
right.
retail customers. It's short duration. Like there's a lot of different risks associated with that. A lot of regulatory issues. Whereas commercial insurance, which is where Fairfax really focuses on, you're dealing with businesses for the most part, and they have to have the insurance.
Last bill they ain't paying is that, right? They
Yeah,
might lay off
yeah,
50% of their work staff, fire sale a bunch of assets.
hmm
They ain't going to quit paying their premium. And so
yeah,
if you look at it, I mean, they do. Your certainty, assuming they're doing it correctly, right? Your certainty
hmm
is very similar to a treasury. It just,
yeah.
when you just look at the way the economy is structured,
Yeah, and
um,
look, if the market, if the insurance market softens, some companies, the way their incentives are, is to grow no matter what, right? If you're paying your executives on premium growth, they'll grow premiums even when they shouldn't, and Fairfax takes a very long-term approach, and is very conservative in how they have their marks and how they reserve. And so one of the interesting things about Fairfax that I think is being underappreciated by the market, because the market's kind of just selling all P&C insurance stocks at once on the basis of a softer insurance market and lower interest rates. But Fairfax itself, it tends to book reserves, such that it's 4 years later after they write the policy that they start releasing the reserves, assuming there haven't been any negative developments, right? So, or adverse developments, they call it. So if there's an adverse development, they immediately take a loss, right? If there's something they didn't expect and they wrote basically bad business, they'll take a loss as soon as they realize that. But if they wrote good business, they don't take the extra reserves into earnings until 4 years later when the average claim has come off, right? Like the risk associated with that claim is now down. It might be zero. It might be gone entirely, or there might be some small tails. But effectively, what that means is that we really should start seeing reserve releases tick up at Fairfax, which means that while the analysts are expecting the combined ratios to go up from kind of 93, 94, where they've been the past few years, up to 95, 96, in fact, it might be that they go down a little bit, which means that the profitability will be more. And every one combined ratio point is about $10 of earnings for Fairfax. So it really can start to add up on an annual basis as they start releasing these reserves. And in Q4 is when they actually do their true up every year. And so I'm expecting them to have very strong reserve releases in the fourth quarter. And so my expectation is that they will once again beat the earnings estimates, and they tend to beat the earnings estimates every quarter because the analysts are much more conservative. And the reason why the analysts are conservative, part of it is they haven't done the work to really understand. I think what's in the equity portfolio, especially,
Yeah.
and they're very conservative because the valuation is less than 10 times earnings anyways.
Which is a
So
bad sign.
yeah, which is, well, it's so cheap that I don't. Most of them have buy ratings. Most of them have buy ratings. Is one, I think maybe Morningstar is a sell, and there's one other that has a hold. But for the most part, they have buy ratings. But they don't really take the time to figure out what earnings could be. They just use very conservative estimates, get to an earnings number that still supports a buy rating, and they kind of stop there. And so when you look at it, they say, well, 10 times earnings, I should have less than 10 times earnings, I should have a buy rating on it. And they do. But what it looks like to a quant, especially, or anyone that's using a screen, right? And almost everyone uses screens now when they go look at stocks. I've talked to some portfolio managers that say, look, they do a screen, someone does a screen for me first and then shows me this is a universe that you can buy from. And Fairfax doesn't make it because Fairfax has a quirky way of reporting where they don't report adjusted earnings. They just, just like Berkshire,
Weird.
they just report, GAAP/IFRS earnings for Fairfax. And so what it looks like to a quant is that the earnings are always collapsing. They always look like they made, $175 last year. And if you look at the adjusted earnings estimate, which is what all the quants are trained to look at and what everyone's screen is trained to pull, it looks like earnings are dropping to like 145 this year. The IFRS earnings are probably going to be closer to $200 a share. So the earnings grew, and but it looks like it's a collapse. And every year it looks like a collapse. And the Morningstar analyst is the worst. He has like he has earnings going down like in half in 3 years because he models in a giant cat loss, like a bigger cat loss than anyone would ever think would happen. He models into his numbers, and so it just looks like you're buying a stock with declining earnings, and who wants to own a stock with declining earnings, right? So the analysts are just wrong on it, which is again, and we talked about how much analysts' earnings estimates drive flows. And so not only do you have sort of what looks like earnings coming down, you also have a really wide spread between the estimates, which means that the earnings predictability is really low. And the earnings predictability, I think there's a high floor, but they're all variable earnings lines, right? The investment income is variable, although probably the most consistent. The underwriting income is variable because you don't know when you're going to get accidents and cat losses that are going to be bigger than you expect. And the obviously the gains on the equity portfolio are variable. So
Well, that's one thing. And to wrap this up, we've talked about we talked about the business, talked about Prem, and talked about our earnings estimates, or what we think the ROE is going to be, and conservatively and aggressively, all kind of stuff. Let's put on our compounder bro hats, okay, and just talk a little bit now. Allow ourselves to be a little bit hyperbolic here. One of the things that excites me the most about this name is when I'm sitting there looking at the board and the board in front of us, and you have the same observation I do, which is this is the most target-rich environment for a value fund manager that I've ever seen in my career. I would feel like a complete moron if that is my assessment of the market and I don't throw some money at a guy like Prem Watson. And the reason I say this, if we're sitting here licking our chops, you talk about a guy that's going to know how to squeeze every bit of juice out of that fruit, right? And part of me sits there and goes, if we're seeing the setup the way it is and knowing him and what he does, I think the highly likelihood is that we'll look back and laugh at 15% ROE.
I think so. Yeah. It's been high teens for the past 5 years or 4 years, and that's with them kind of understating earnings in a lot of ways over those years, right? Where they've kind of booked more reserves than most of their competitors probably have, and which again will be released. There's like 3 or 4 things in the investment portfolio which we know are undervalued by maybe $2 billion, right? So they have they own
Yeah, what are they invested in? Run me through the
Yeah.
retail book. What are they? What names do they own?
Yeah, so they don't own that many publicly traded equities like in the public stock portfolio where they don't have control. We talked about Eurobank, that's their biggest position. We talked about Poseidon, which is private, which used to be Atlas Corp, which they took private with David Sokol and a consortium of a shipping company consortium. They have the TRS. So those are their top three positions, like their own stock, Eurobank, and Poseidon. After that, they own a lot of. They've been growing their privates portfolios. They've been taking private companies that are I think are of higher quality companies with high return on invested capital that they're
Well, and
getting
the
at
reason,
a
and
fair multiple.
correct me if I'm, and I don't mean to interrupt you, but I would assume one of the reasons they're shopping in private is this is another anomaly about this market. I can take a regular business, slap it in a public shell, and instantly the market acts like it's worth 10x.
Yeah, well, it depends, right? There's a bit of both. In some cases, like a company that's public that doesn't screen well, you can pay a
That's
decent
true.
premium and still take advantage of it, which I think is what's happening with Kennedy Wilson, one of the ones that they're trying to take private now. But they in Canada they bought like Sleep Country, which is like the number one mattress seller
Yep.
in Canada, where they have giant market share and have incredible free cash flow, and they took that business private. They own like big restaurant chains in Canada. They own like Golf Town and Sporting Life, so a bunch of retail type store things. They own the Bangalore Airport, which is in India. They own their publicly traded subsidiary called Fairfax India owns net 69% of that airport, and Fairfax owns 43% of that. And Fairfax gets performance fees from Fairfax India. It's basically a publicly traded private equity vehicle for India, and the airport is marked at least a half, like 50% of where it should be, right? So you can get like a gain when that business IPOs, which they're trying to IPO that airport right now.
I
The
was just
mark
going to
will
ask you. I
probably
was just
double.
going to
Yeah.
ask you if they had the willingness to flip some of this public if they thought it was attractive.
Yeah, and one of the beauties of Fairfax, which I think is part of the reason why it's a better mousetrap than Berkshire, is that they tend to invest with management, and when management wants to sell, they usually sell, and they don't mind selling stuff and switching into something else, right? So with the airport, I think it's not they sell it. It's not to sell it. It's to sell it to get capital to keep doing more infrastructure investments in India.
Well, I
But
would
it
think
will increase the mark, and that'll be a big gain on the portfolio.
I would think that advantage of being a better mousetrap than Berkshire, and I would agree with you. Part of that probably just has to do with size. I mean, you think about the
Yeah.
universe of
Yep.
investments that's open to them. It's so many where,
Hmm.
in reality, I mean, Buffett maybe has a universe of 100 different things he can pick from.
Yeah.
That would really have the potential to drive any returns.
Yeah, and Berkshire has a curse of success, right? They were
Yeah.
so good on compounding the equity book, and Fairfax kept growing their insurance business, right? So they kept doing insurance deals, and continue to grow that. And more recently, I would say like from 2010 to 2020, the equity book really suffered, right? So, but now it seems like the valuations of the equity book are so low that the returns are actually significantly higher than
Mhm.
they have been. But so we talk about like giant. There's probably a giant gain that's unrecognized on the airport. There's giant gains on stuff that's public that we can see that the fair market value is above the carrying value with Eurobank and with Poseidon. Poseidon's not public, but another one where we have it marked at 7 times earnings. It's probably worth 15 times earnings. David Sokol told a bunch of us at the AGM last year or this past year that it was probably worth twice where Fairfax had it marked, and so that's another couple $1 billion. And then they have a insurance company, an AI fintech insurance company where they partnered with Blackstone called Key, which is London based, and they invested $100 million 5 years ago, and it's gone from $0 in premiums to $1 billion of premiums.
Wow.
So that business, when it lists, and if you read the shareholders agreement, that's the plan, is to list it at some point. That it will probably list for like 5 billion. So that $100 million investment will turn into a $2 billion windfall, effectively. The mark will go up, right? They did something similarly in India with a company called Go Digit. And Go Digit was basically going to like a paperless approach to insurance in India, and that business has grown from nothing to 3% type market share. And they started in 2017, and that business actually did IPO. So they turned like $150 million into 3 billion. So they've done this before. You kind of get every kind of investing style when you buy Fairfax. You get public market investing, you get VC investing, you get private equity. When they take these businesses like Sleep Country private too, instead of like putting 6 turns of leverage on it, they might put 4 turns of leverage on it, right? And to make sure they get to their 15% sort of target for equity investments. And so there's a number of these things in the portfolio which could each create a couple $1 billion worth of gains that we know about. And every year there seems to be 1 or 2 things that they sell that we didn't even know about, where they book a decent gain that helps the earnings for that year. So there's a bunch of stuff in that portfolio that's really interesting, and cheap. And that's the thing about like Fairfax's portfolio gets me excited because of how cheap it is. Whereas I look at their best 2 comps are Berkshire and Markel, and I look at those 2 portfolios and I go, that's a lot of stuff has trades at fair prices, or
Yeah.
might be expensive, because they own a lot of quality stocks that everyone knows about. Whereas Fairfax, most of their sort of quality stock investments are a little bit are outside of Canada, outside of the U.S., which really helps make the valuations look a lot more attractive, or the growth prospects are a lot more attractive.
No, man, we're gonna. I do not currently own this book, this yet, but we are going to
Yeah.
be taking a big look at it, just because, like I said to you, Prem's been on my mind, Fairfax has been on my mind. It's one of those things that keeps crossing my desk, and listening to you talk about it just kind of back that up. Yeah, go ahead.
I gotta say that all your viewers should buy this book. It's called The Fairfax Way. It just came out on November 18th, so it hasn't been out for very long.
I'm gonna get that.
It's the first time they let someone in, and sort of gave them the inside scoop and let everyone talk to the journalist and author David Thomas. And David Thomas is, I believe he was like editor of Financial Post, maybe the Globe and Mail, Canadian Business Magazine. So he's got a lot of credibility in Canadian circles. And they invited him in and sort of gave him the background. And so you get the first 2 parts of the book is kind of the history of the company. And then starting in part 3, it really talks about how they borrowed from all these great investors over time. And it really, it can really make you confident in the culture, give you confidence in the culture. The one thing about like, Berkshire with, it's in the news a lot because Buffett, is stepping back, and obviously he's quite old. And Prem's 20 years younger, he's 75. So hopefully he has a lot of time left. But when I look at the team that's around Prem, it gives me a lot of confidence. A lot of very smart, kind people who are generous in their giving, but also in their in their time that they're willing to spend with investors at the AGM and so on. They're all super nice, and they're super high quality, and the team around him, I think, will keep this hopefully looking like it does for generations to come. And I think that I mentioned my friend Charlie before. He was quoted in Barron's today saying, buying Fairfax is like buying Berkshire in 1993. And I think that's probably a pretty good assessment of the situation. And over the next 5 years, will it have the same returns Berkshire did from 93, 98? That's entirely possible, given what we've talked about. ROE, book value could compound at 20% a year, and the multiple could double.
No, yeah, you want to talk about horse for a course, right? Horses for courses. You couldn't envision a better course for him. He's got to be licking his chops. When you tell a guy like he and Buffett that the main investment, the philosophy or mechanism does not take valuation into
Mm-hmm.
consideration, they got to start
Well,
salivating.
you'll like this. He's got gold investments. He's got copper investments. He's got oil sands investments in
I
the
think he had
portfolio.
to. Yeah, I figured he
Right.
would. Yeah.
So and again, and when most people who invest in something like Berkshire or Markel see the equity portfolio, they run away because they don't want to own that stuff because they want to own quality, right? And so they're not getting their signal. They're not getting that those boxes ticked that they look for when they make an investment. And so, what Prem has done is just partnered with the highest quality people in those sectors and make sure that if he's buying a commodity business, that it's a low cost, long reserve life business, right? So you want high margins, low costs, survive the cycles, and make a lot of money throughout the cycle. And just like I'm partnering with Prem. We're all partnering with Prem if we buy Fairfax. He's got, he controls the company. He has a lot of stock, a lot of skin in the game. He's invested with a gentleman called Adam Waterous, who runs Waterous Energy Fund, and they have oil sands investments in two public companies. One's called Strathcona Resources, and one's called Greenfire Resources.
I know both.
And so he picks these partners that are going to make sure that they earn outsized returns over time. And I'm personally invested in both of those companies as well.
Look,
so
I think that I don't think you can sum it up. I've had this argument so many times, and I look at people and I go, yes, mining is a bad business, but Warren Buffett once said it many times, if you buy a bad asset at a really good price, it makes a phenomenal investment, right? And I keep looking at American investors and going, hey guys, you're right. You're buying great, most of them. You're buying great businesses. You're just paying really bad prices for them, and that's when I think there's a big opportunity, going on out there, I want to take advantage of it, but B, I also want to go to the guys that I think are the best at taking advantages of that, and not being too prideful, right? I don't care how I generate the returns, whether it's my name, my idea or Prem's. I don't care. I just want to have a piece of that. So I appreciate you coming on, Asheef, and visiting us again and laying this case out for Fairfax, because it fits perfectly into what we've been talking about, the opportunities we see. And, if you're an investor out there and you're not looking at these kinds of opportunities, you're doing it wrong. And because there's so many of them out there right now. And I'm not telling you to sell all of your stuff. I'm just saying, at the very least, get some of this stuff in your book, get some exposure outside of US markets, get some stuff that isn't just a part of everybody's screen. So Asheef, let's see where the folks can track you down. I've got your Twitter handle here at Brown Marabozu. Let me just spell that out real quick for the folks. It's at Brown, BROWN, and then Marabozu, MARUBOZU. And that's it, right? Do you have any other ways for the folks to track you, or is that the best way?
Yeah, I have a Substack as well called Berksey Park Capital, BERCZY. I share all my ideas for free. I answer questions on Twitter if anyone has questions. I don't sell anything, and so and I just enjoy the feedback, and I enjoy interacting with people. And I want to know why they don't like my stocks, because if I'm missing something, I want to know.
Amen.
So,
I feel like that's one of the most useful parts of Twitter. Throw an idea out there and have everybody tell you how stupid you are, and that's saved me from making some bad investments.
Yeah.
It's also confirmed that I've made some good ones too. It's cut both ways, right? So anyway, all right.
I always think they're wrong and I'm right, but a third of the time they end up being right. So
yeah, weird how that works. It's what makes the market. All right, Asheef, thank you so much. And thank you guys for listening. I hope you'd enjoyed this as much as I did. We've got another one coming online next week that you guys should like. So stick around, keep your eyes on the cast. Anyway, you can follow us at Know Your Risk Podcast, get our video feed on YouTube at Know Your Risk Podcast, and go to the podcast site. You guys know the drill. Thanks for listening. You're listening to Know Your Risk Podcast. Download and subscribe at knowyourriskpodcast.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.